All right, so what's good, y'all? Let's elevate it back with part two of options trading for beginners. Today we're going to be talking about the options chain, and I'm going to give you, a walkthrough of how to actually select an option, strike price, and things like that, and to give you a better understanding. So, once your brokerage account is set up and funded to actually begin options trading, the next step is to know about the options chain and you know how to select what option you want to jump into, be that a call or a put. um let's go ahead, let's get into some of these brokerage apps and give you a brief run through of what's going on in the options chain. All right, so here's my Robinhood account. Why somebody say, oh, you only got 1 penny in there, so what? So freaking what? But this is on my mobile device. It's gonna look different on a computer. You have pretty basic information. Well, not basic. It's not bad. I have all my watch list here. So I have my stocks that I'm watching and stuff like that. I'll click on one of them, and I have my list of stocks. Let me get a good stock. So I got Nvidia right here. Which is at 177.62 at the time of this recording. I'll click on that. I have my chart here. Robinhood has line charts unless you change the settings. And if I wanted to place a trade, what I'll do, I'll hit the trade button down at the bottom. With options trading ability, you have the button to trade options. So you click on that. Now, I don't use these four boxes to where it says single leg. You got long call, cover call, long put, cash secure put. You got vertical spreads. Those are more advanced strategies. But let's just say I wanted to place a trade. I'll pick an expiration date, and they go by expiration every Friday, by a week. And if you scroll over, you see how long the options chain can be let out to, which is January 1st, 2028. But I can tell you right now, those are going to cost a grip of money. But let's say we wanted to place a trade for October 3rd. You have buy and sell, and then you have call and put. So if you wanted to think that the stock was gonna rise by Friday, you would buy a call. So a call and put, the way you think of it, for those that don't know, like you'll pick up your phone to call somebody, and you'll put the phone down once the call is done. I don't know if that makes sense. I learned that from the YouTuber Keenan Grace. A call meaning you want the stock to go up, and a put means you want the stock to go down. You can make money in both directions. So now let's look at where in the middle of the screen it says the share price. So with a call, the strike prices, which is where it says 180, 182, 177, 175. Those are strike prices, right? Now most people are gonna teach it to where it's like, oh well, how far do you think the stock is gonna go by the expiration date of the contract. Nah. I go by how much money do I want to risk on this play that I'm about to jump into. So you might hear in the money and out of the money. So the share price is at 177.62. Now the calls that are below where the share price tab is at, those are in the money. And the ones that are above the share price, when it comes to a call, are called out of the money. And you might also hear the term at the money. So in this instance with the call, if you hear somebody say at the money, that'll be the 180 call. That's right at the money. Now, I don't want to make this too difficult, but now you're gonna see all type of different factors. Once you click on that option chain, not the options chain, on that option strike, you got let's see what's notable. The IV, implied volatility. Now, as implied volatility rises, so will a premium on that option. So IV is like super high at the very beginning of the day, or if a lot of calls and puts and trades are coming in, at the same time, the IV is gonna go up. So always just keep that in mind. Then you also have a chance of profit, the volume, which is how many trades have been coming in and out throughout the day. I'm recording this on a Saturday, so this is information from Friday. And then you have open interest, which also contributes to implied volatility. Now the Greeks, Delta is going to be, if a stock price goes up $1, how much will your options contract go up? So for this one, I'm sorry, I forgot how much $224, right? So you pay $224 for this option. Now, if Nvidia price goes up from 177.62 up to 187.62, your delta is gonna move up $41. I mean, your option contract is gonna move up $41. Game I don't really pay too much attention to. Theta is -25. But remember, it's control of 100 shares. So every day that goes past, the value of that options contract is gonna lose $25. Just from, if you're gonna hear the word theta decay or time decay, same difference. So that's just something to keep in mind. So here I am on my Webull. This is my Webull watch list. Now remember, we just checked Nvidia on the Robinhood account. Webull chart is leaps and bounds better. Sorry, not sorry. I've been using Webull a whole lot more than usual lately, and I've been getting pretty good results. So here, the layout looks different. It's going to be mostly the same information with a few quirks. So let's say you wanted that Nvidia option. You hit click options down on the bottom. Now you see you got a lot more information right in front of you without having to scroll and look for everything. Now here you have the bid-ask spread. So let's say you were to buy the Nvidia stock right now, you gotta pay 224. And let's say you were to sell it immediately without anything moving, the stock price stayed exactly the same, IV stayed exactly the same, everything. When you go to sell it, you lose $2 because of the bid ask spread. I know it says it looks like 2 cents, but remember everything is times 100 in options trading per contract. So that's why it looks like it does. But that's just, it is what it is. So here you would click on the 180. Now you could set your limit price, or you could buy it at market price, stuff like that. You see, you got a lot more options on Webull. But this is a beginner friendly video, so it's 224. Let's say you wanted to pay 220 for it, which will give you a better entry. You could tap the plus or minus, or you could tap over near the limit price, and you could put 220 there and click next. Okay, or you could also change it to a market order, which means like you'll buy it wherever it's at, however much it costs, and you'll instantly be in the play. That's just something to keep in mind. But the same rules apply as far as with Theta and Delta and all this other stuff. It may be slightly different depending on the brokerage, but more so that's just what it is. Okay, y'all. So that was just a quick run through of options and how to start trading them. Now I know the example that I gave with both of the brokerages was call based, but let's say you were to try to jump into a put, meaning you wanted to make money while the stock price was going down. It would be the exact opposite. So where the strike price was once you're in a put, now you want something that's at the money, which is going to be the one right below where the strike price is at, that little bar that I showed y'all. And then the in the money puts would be the strike prices that are right above where the share price is at. Just a little tidbit, to add to your thought process. So a put is exactly the same as a call, except in the opposite direction. Now there are little nuances that I'll diverge into a little bit later on in this series, but the process is pretty much the same with any brokerage. You just have to find out where the options chain is at in each particular brokerage, because it's a little bit different. Now, I showed you how to do a limit order, a market order, and it's going to be the same thing, once you go to sell. But again, I don't want to make these videos too long in length. I want everybody to keep returning and gaining a little bit more knowledge at a time without actually going into brain overload, because that is a thing. Anything you have a question about, just drop it in the comments. I actually do my best to try to answer each and every person, and when they reply, I don't necessarily see all of the replies, or there's nuances like I'll try to respond from my phone and then I'll go on YouTube Studio, from my laptop or from my desktop, and it'll say that I haven't actually responded. So if I don't, just give me a heads up, get my attention, and I definitely will, because I don't know about you, but I don't play about my money. And again, this is not financial advice. of course. But yeah, I'm here to help out in any way that I can. If you need to reach me, you know, there's people in the community that have my phone number personally. There's people that I'm connected to on Instagram and whatnot, et cetera, et cetera. Um, but yeah, this is going to be part 2, understanding the options chain. We've talked about strike prices. We've talked about IV. We've talked about data. We've talked about delta. I think those are the most important factors. We've talked about the bid ask spread. Anything you need a further deep dive into, just let me know. And as I keep the series moving along, you know, I can make separate videos also. But we're gonna wrap this up here. This is part 2 of options trading for beginners, understanding the options chain. Everybody take care, and I'll see you guys in the next video.